welcome back. Thank you again for the love and support on the most recent video. Seriously appreciate all of it. If you aren't subscribed to this YouTube channel though, as many of you aren't, make sure you are, as there is a ton more crypto related content coming, as well as Hedera specific content that I am currently making ready for the inevitable explosion in the Hedera ecosystem, particularly to do with decentralized finance, decentralized applications and games, etc. There's lots of stuff being built at the moment. Anyway, lots of different news to cover in today's video, and I'll be rounding the video off from a fantastic Medium article written by SourceSwap Labs to talk about how Hedera solves a lot of the Ethereum challenges that currently are on that chain. So, Crypto Fear and Greed Index at the moment, we're still at an 11. As we said before, this tends to be a great opportunity to buy once we are in these zones. We're not in the greed zones, typically a time to take profits. My strategy still goes unchanged. For many of you that have watched plenty of these videos will know that I'm continuing to average into my positions. I'm still picking up a ton of Hedera or Hbar wherever I possibly can, particularly with a lot of the developments we're seeing in the markets at the moment. If we talk about Bitcoin, the accumulation is beginning to go parabolic. So we can see the number of addresses with a balance greater than or equal to 1 is still increasing massively. And that just continues to ride upwards as the price decreases, as people are averaging into those positions. Not only that as well, banks are now using Bitcoin for reserves. Probably nothing, but the Bank for International Settlements to allow banks to keep 1% of reserves in Bitcoin. And then obviously CZ there with a bit of sarcasm saying probably nothing. Clearly, this is absolutely massive, and one of the main reasons a bank would be using Bitcoin for its reserves is either potentially to earn a small amount of return on investment for holding those or holding dollars in an alternative asset such as Bitcoin, but also potentially stability. It could be them hedging any other inflationary risk from holding raw dollars. And we can see this breakdown in Group 1 and Group 2 style assets. I'll try and leave this link down in the description below for you guys to read through. It's a little bit technical or technically minded. However, it's an interesting read as to why banks may be choosing to do this. Regardless, it is bullish for Bitcoin. If we look at a quantifiable figure as well for that graph I just showed a second ago, the number of addresses holding at least one Bitcoin has reached another new all-time high of 875,799. This just keeps on increasing day by day. We keep seeing new records get reached for the number of addresses holding more than one Bitcoin. Talking about the majority of the markets, the S&P 500 has closed the first half of the year with the worst performance in 53 years. In fact, it wasn't just the S&P 500, the NASDAQ and the Dow Jones indexes as well have performed incredibly poorly, some of them being worse performance than 50 years. Seriously bad stuff across the markets. However, this just goes to show as well what we're seeing in crypto is a macro-driven event. It is not isolated to cryptocurrencies whatsoever. No matter what people say, we are experiencing one of the worst bear markets we have ever seen. Obviously, a lot of that comes from the economic stimulus we saw due to C19 a couple of years prior. Not only that, as well, we can see 10 stocks in the S&P 500 lost $4.2 trillion of investors' money. Over double what the market cap of cryptocurrency was back in the end of 2021. They aren't necessarily the worst performers in the index on a percentage basis, but the companies are so large that the market values have plunged the most. And typically a lot of these are regarded as very safe assets in the equity space. You've got massive tech behemoths such as Apple, Amazon, Microsoft, Alphabet, Meta Platforms, obviously formerly Facebook, Tesla, Nvidia, Netflix, Home Depot, and PayPal Holdings, all losing billions of dollars across the board, summing to that 4.2 trillion. So at the moment, it doesn't seem to matter where you park your money. You are taking a huge risk in the equity markets. However, regardless, as many people may be telling you, this could be a great opportunity to purchase if you have conviction for the long term. I always stress that in these videos, as there is no magic pill or crystal ball to make money quickly within these markets whatsoever. Investing tends to be a long-term game. Majority of the statistics that you can read or see will all correlate to it being a long-term game, and most of the people that try and play a short-term game get burnt very, very badly. We can also see from this is some predictions from different investment firms or institutions with their predictions for the end of 2022. And almost every major S&P 500 strategist actually thinks we will end the year higher, and many think that we will hit a new all-time high by the end of December. So what this is effectively saying is we may have had one of the worst halves to a year in 50 years for the S&P 500. However, they generally believe across the board that things will turn around massively in the second half of 2022, and we may even see closing positions higher than what we have seen previously. Now, of course, this would be very good for cryptocurrencies as well, as you'd get a shift from risk off back to risk on as these equity prices continue to increase, and then many people will be looking again back towards cryptocurrencies to try and edge out a little bit more alpha. This again ties back in with that that article I read the other day, talking about how analysts have been predicting $28,000 to $30,000 for Bitcoin's closing position for the end of 2022. And of course, if this does play out with these S&P 500 predictions, that is certainly on the cards for cryptos. Let's jump across then from some valuations across to some chain news or wallet centralized exchange news. So unfortunately, crypto.com has now just imposed limit withdrawals to $3,000 daily, which is 3 times lower than Voyager. So unfortunately as well, this is very suspective timing, as we're seeing a lot of other centralized exchanges have liquidity issues. You've got 3 Arrows Capital and other investment vehicles that are effectively defaulting now and facing bankruptcy. And this again just goes back into the not your keys, not your crypto. By all means, use centralized exchanges to onboard yourself into the ecosystems. So i.e. convert your fiat into some form of cryptocurrency. But once you're holding that cryptocurrency, certainly transfer that across to a wallet you hold the keys for. So whether that's an online wallet such as Hashpack if you're in the Hedera ecosystem, or MetaMask for things like Binance Smart Chain and Ethereum, or even better still, if you do own a hardware wallet, it's well worth utilizing that if the tokens that you're purchasing are supported. Just make sure that you've got the seed phrases and private keys. Therefore, you own the crypto and you can't be hit by these sort of suspensions that are getting thrown around. Fortunately, at the moment as well, Binance hasn't really imposed anything and they seem to be performing quite well across the board. That's the exchange that I personally use. Another Solana hack has taken place. 𝗥𝗘𝗙𝗏 Finance, attention, our protocol seems to have just experienced the hacking, temporarily suspended the program and are investigating it. Updates will be shared here as soon as possible. Thanks, Mitch, for tagging me in this one. But again, I don't know why people are doing this to themselves. Stay away from these chains that are seeming to be hacked left, right, and center and having issues across the board. I've done several different videos covering why Solana could be experiencing or will experience a meltdown in the future, and a lot of it is down to security risks. There have been some very big security firms that have heavily audited Solana, and they are concerned as well and have even branded it a potential threat to users' funds being very likely. And we are starting to see this across a lot of the sort of layer 2s that are built on top of Solana itself. Again, this I guess is another warning, another stake in the ground to show that Solana isn't as safe as it has been touted to be. Check out some of those other videos on my channel, and there's plenty more information that you guys can read about online. Now, of course, Solana could still appreciate very quickly as a token. There's nothing wrong with holding a Solana token. However, be very careful if you are purchasing some of the other projects via their decentralized exchanges on Solana, as they keep having issues. Get ready, coupons are about to get a major upgrade. So Brandy Johnson, the CEO of the Coupon Bureau, has spoken with FMI.org on the universal coupon standard, which will combat fraud, improve cash flow, reduce chargebacks, and more, of course, built on Hedera. This is a use case I've covered several different times now, and we should see a go live date sometime during this month of July. Again, this is another huge use case involving massive existing chains such as Walmart and Dollar Tree stores over in the United States, and aims to bring thousands, millions, even billions of transactions across to Hedera, similar to 𝗟𝗏𝗡.io. Again, this really marks a milestone for the Hedera network, and we should start to see those TPSs increase massively. Another great Cointelegraph article as well, which is featuring HEADSTARTER. So HEADSTARTER ignites Web 3.0 season as Hedera Hashgraph's first Layer 1 launchpad. So HEADSTARTER is pioneering the emergence of Web 3 applications on Hedera by offering a suite of services that accelerate the platform's crypto project development. A reputable launchpad with project acceleration support will bring long-term value to the Hedera ecosystem, currently emerging from greenfield development. Web3 and decentralized finance applications on Hedera have motivated ecosystem partners and the community to participate in HEADSTARTER's IDO. HEADSTARTER strives to be a pivotal infrastructural Web3 stack component for Hedera's projects and user base, paving the way for Hedera-based smart contract audits as a legitimate DeFi protocol to drive mass adoption. HEADSTARTER is also growing Hedera's visibility and interoperable integrations with Know Your Customer, regulatory technology support, anti-money laundering, centralized exchange support for Hedera native tokens, as well as ecosystem funding and more to fast-track the development of native Web3 projects. How HEADSTARTER is helping embrace Hedera and particularly DeFi on Hedera. And then obviously this ties back in as well with that alliance between HEADSTARTER, SOLANA, and 𝗟𝗓𝗏 Hedera. Lots of good things happening at the moment on top of Hedera. Right, round this video up with a slightly longer article, but a fantastically and well-written one by the SOLANA Labs team. And it is how Hedera Decentralized Finance, or DeFi, is overcoming Ethereum's shortcomings. So we should all know by now that the Hedera network is fast, fair, secure, and well-governed, which provides the trust layer that our ever-growing community relies on, and that was obviously said by Dr. Lehman himself. The use case of DeFi is clear and simple to the vast majority of market participants in the crypto space, namely on-chain access to services traditionally offered by banks via trustless smart contracts. The general ethos revolves around a sort of libertarian right to self-sovereignty with a focus on egalitarianism. In theory, every individual may access these money markets using the same technology with complete transparency and no special advantage over the protocol. For money markets to be capital efficient and attractive, they need high liquidity. Go where the money is. For now, this happens to be Ethereum. Ignoring the highly fragile ecosystems or systems we have seen collapse in 2022, such as Terra and a number of other protocols rebranding perpetual motion machines to a new crop of speculators, DeFi is here to stay. However, it doesn't need to stay on Ethereum, or does it need to stay on Ethereum, I should say. Though protocols such as Aave or MakerDAO are sustainable, fair systems which have proven resilient to market volatility, the platform upon which they are currently housed is not as fair a system as it may seem. What are they talking about? So DeFi on Ethereum is plagued by three different problems. Prohibitive costs, many of you will know via gas fees, low throughput, so it can't process many transactions, and a lack of fair ordering, so MEV. Take Curve, for example, as writing of this, the cost of a token swap is $4.66. While this seems rather high, one should remember this is relatively low when compared to historical data. And many of you should be aware of that if you checked out my videos using Hashport for the Dovu tokens, using the Hedera token service to get them across. Some of the gas fees that I were charged during that video were $20 to process a transaction, which is absolutely absurd. Fees on Ethereum are priced in 𝗟𝗓𝗏. So 𝗟𝗓𝗏 is to Ethereum what sats are to Bitcoin. It's a fractional representation of an Ethereum token. When the price of Ethereum rises, so does the US dollar cost of transacting on the network, as can be seen when comparing the above figure with the ETH USD chart. Sharp rises in the price of Ethereum also correlate with demand for block space. This creates a negative feedback loop for users and protocols whereby demand effectively destroys itself by making the use of mainnet cost prohibitive. Again, we don't have that issue on Hedera, which this article does talk about. The variable nature of Ethereum's transaction fees makes it difficult for developers to take costs into account when looking to build what is fundamentally a business on Web3. Again, something that I've mentioned so many times. This is why the fixed fee structure of Hedera is incredibly crucial for enterprises looking to enter Web 3.0. They need to be able to make a financial justification as to why they are going into some form of project or venture. They can't do that on a layer one, such as Ethereum or Avalanche or Algorand, whatever it may be, because the fees themselves are paid in fractions of the token. If that token price increases, the fees to process those transactions increases. If you are running billions of transactions through a service and the fees increase by 100%, no matter how small, that has doubled your cost base immediately, and that may be, at the end of the day, affect the gross margin or profit margin of the venture that you're undertaking. There simply is not enough block space to run anything remotely similar to modern banking infrastructure on Ethereum. Ethereum runs a maximum of 30 transactions per second. In comparison, Visa can run up to 65,000 transaction messages per second. So the scale is just not there for existing solutions like Hedera. The technical limitations of Ethereum, coupled with its high demand for block space, give rise to DeFi's third problem: miner extractable value, or MEV. Miner extractable value consists of a live auction by market participants, each using 𝗟𝗓𝗏 to bribe miners to include and validate their transaction before another. So if any of you have used these chains in the past, you know you can up the gas fee that you pay in order to prioritize your transaction. MEV searchers, as they're called, typically profit from this backdoor arbitrage by front-running large market orders and pocketing the difference. Arbitrage is a normal and healthy part of any market. However, this kind of arbitrage sacrifices the fair ordering of transactions. Again, this is something that Hedera natively solves. Fair ordering of transactions is built in to Hedera by de facto. When developing SaucerSwap, we knew it had to be future-proof, a protocol which stood up against the rest of the market's DeFi offerings, while also addressing the core problems users are growing increasingly tired of on Ethereum. The Hedera hash graph offers us and our users up to 10,000 transactions per second being throttled, alleviating throughput concerns. Predictable fees paid in Hbar but denominated in US dollars give us the freedom to explore ideas that would be impossible on other DLTs. Lastly, the concept of MEV does not exist on Hedera, meaning the network is free of bribes and exploitative backdoor arbitrage. The hash graph always guarantees fair ordering of transactions, which gives rise to secure and fair network upon which next generation dApps and protocols can be built. Fantastic article by SaucerSwap highlighting the key differences between not just Ethereum actually, but many other layer ones in the space, and why Hedera has a significant competitive and comparative advantage over the remaining layer ones, and is also a great solution for enterprises across the board. Hopefully you guys enjoyed this video. If you did, leave it a like, drop a comment if you've got something to say. Lots more content coming your way from me anyway. Until the next one, I'll catch you then. Cheers.